Welcome to GRE. I'm your host, Keith Weinhold. Today's prominent macroeconomist feature guest will tell us both when and why he believes the recession will begin and when interest rates will be cut. Also, could we have higher interest rates and inflation for an entire decade? Learn how all of this affects your financial future today on Get Rich Education.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE from Boston, Massachusetts to Austin, Texas, and across 180 nations worldwide. I'm Keith Weinhold, and you're listening to Get Rich Education. After the guest interview today, I'm going to have some more comments, especially on inflation and what I call monetary vandalism. Today's guest is also the first guest that we ever had on this show 9 years ago, and that began a relationship where he's become a GRE regular here. And I'll just share something with you. Back in 2014, when this show began, I felt like I had a message that you need to hear, but I did not know if this show would become a success in any form in those early days. In fact, back in 2014, it seemed like I regularly had to explain to people what a podcast even is, but I don't need to do that anymore. After the first 6 episodes were complete monologues from me, no guests, I had my friend John Collins helping me with the show at that time, and we thought about reaching out to some of the nation's and world's most prominent guests about an appearance here, and I was, as it turns out, inside Alaska's Fairbanks International Airport, of all places, in November of 2014, when I got a text from my buddy John. There were just 4 words, and those words were, "Dude, we got Duncan," with an exclamation point at the end. And I replied to him to clarify back then, like, do you mean that Richard Duncan is coming onto the show? So, yes, internationally revered economist Richard Duncan was our first ever guest back in episode 7. And it's also like that was the first professionally recorded interview that I ever did or produced. And I still remember before that interview, I was Googling things like how to interview someone or how to interview a guest. And I remember that all that kept coming up was like how to nail a job interview if you were interviewing to try to get a job. Not what I wanted. Well, with no further ado, let's talk to Richard about when and why this recession that's perpetually just around the corner but never begins, will begin, and when interest rates are going to be cut, and also could we have higher interest rates and inflation for a decade? This week's featured guest has had a remarkable set of elite financial roles in this world of ours, including for the World Bank in Washington, D.C., and as a consultant for the IMF, a prolific author. Last year, he published the book, The Money Revolution. Ever influential, he delivered a speech to 15 members of the House Ways and Means Committee in D.C. earlier this year. Maybe we'll learn more about that. He is now the publisher of Macro Watch. That's a video newsletter, and that analyzes the forces driving the global economy in the 21st century. Interestingly, you might remember, if you're a longtime listener, he is the first ever guest on GRE back in 2014, and he returns now as the freshest guest on the show as well. Hey, it's a big GRE. Welcome back to macroeconomist Richard Duncan.
Hey, thank you very much for having me back on.
I believe you were last here in March of 2022, back when the Fed funds rate was about 0, just before mortgage rates started climbing a cliff. So much has happened in that past year and a half to 2 years.
Just incredible, yes. Russia had just invaded Ukraine the month before. The Fed had not started quantitative tightening yet. No one had heard of ChatGPT. So, yes, the world has changed in the last year and a half.
Yes, 100%. And all that time, we've been hearing about this economic slowdown that really hasn't occurred. Employment is still high. GDP growth in the United States is evident. And there are a lot of other positive economic signs that just continue.
You're right. I mean, when we spoke, I expected that there would be a recession in the not too distant future. I think most economists did.
Right.
And of course, we did have 2 quarters with negative GDP growth, but it was very small. Soon after that, the economy rebounded. And currently, the expectations for the third quarter are for strong economic growth, relatively speaking, for the U.S. economy. Despite all that, I continue to expect that the U.S. will fall into a recession in the not too distant future. And here's why. The main themes of MacroWatch, my video newsletter, the main themes that run through my work there is that credit growth drives economic growth and that liquidity determines the direction of asset prices. What I mean by that is when the Fed is creating a lot of money and pumping it into the economy, stock prices and other asset prices tend to go up. And when the Fed is removing money from the economy, as it's doing now through quantitative tightening at the rate of $95 billion a month, that tends to cause stock prices and other asset prices to fall.
Which is currency destruction currently occurring.
Absolutely. The Fed is destroying $95 billion every month now. That adds up to $1.1 trillion a year.
Yeah.
So from the peak, they've already destroyed $1 trillion, or roughly 11% of the total. And if it goes on for another year, they'll destroy another 1.1 trillion, which would represent 14% of the total from here. So as the liquidity tightens, what this is like, just imagine a ballroom full of investors and everything's fine, but the Fed then begins pumping the oxygen out of the ballroom through quantitative tightening, removing the liquidity or the oxygen from the ballroom. At first, the investors don't tend to notice everything's fine. But as this goes on for a while, it becomes increasingly difficult to breathe. And at some point, they all notice and panic and run for the doors. So quantitative tightening tends to eventually, with some lag, create some sort of event in the financial markets that is very unpleasant for investors and ultimately forces the Fed to stop quantitative tightening. That's the environment we're in now. Liquidity is tightening, and also credit growth is very weak. Normally, if credit grows by less than 2% a year in the United States, that's adjusted for inflation, we fall into a recession. That happened 9 times between 1950 and 2009. Things have been more complicated since 2009 with all of the quantitative easing and massive government stimulus. But now we've had almost 2 years where the total credit adjusted for inflation has been less than 2% a year. This is an extraordinary anomaly that hasn't happened since at least the 1950s. And it looks like going forward, because interest rates are so high, that credit is going to continue to slow down. And so as credit growth slows, economic growth should also slow, because in this new age of fiat money, credit growth drives economic growth. And without credit growth, the economy goes into recession. And if credit contracts, we go into depression.
I'm not a very good dancer, so removing all the oxygen from the ballroom might actually be doing me a social favor. Hey, maybe it would make me more comfortable. But yes, you're talking about money is figuratively burning up here. And this is so consistent with what you told us the very first time you were here as the first ever guest on this show 9 years ago, when you talked about the importance of plus 2% real inflation-adjusted credit growth is needed in order to keep the economy from going into a recession. Just exactly consistent with what you've been telling us for a long time. But now there's this potential anomaly that's been introduced that's sort of thwarting this slowdown. So what is anomalous about this, Richard? What's different? What's changed?
You're exactly right. When models give you the answer you don't expect, then you have to ask yourself, why is that? And so I've been thinking a lot about this, and I believe the reason that the economy hasn't gone into recession yet is because the amount of stimulus from the government during the COVID pandemic was so extraordinarily large. That's the kind of stimulus and government spending we would see during a wartime. And of course, wartime government expenditure revs up the economy. and powers it for a number of years into the future. So, for instance, just in one quarter, in the second quarter of 2020, U.S. government debt increased by almost $3 trillion in 90 days. And over that same period, the Fed created roughly $3 trillion over that same period to finance that government borrowing. So that was just in one quarter of massive government stimulus. Altogether, the stimulus was more or less $5 trillion of fiscal stimulus from government deficit spending and roughly $5 trillion of money creation by the Fed. That was on such an unprecedented and extraordinary scale. And so over such a short period of time, I believe that that has been powering the economy ever since. The question is how much longer is it going to continue to power the economy? And that I'm still uncertain about. But with interest rates so high, and maybe with them going even a little bit higher, combined with quantitative tightening, which should cause asset prices to fall, creating a negative wealth effect that would deter consumption, that and a number of other factors we can touch on all suggest the economy should weaken and go into recession, probably in the first half of next year.
So to provide some framing here, Richard talked about it, about $5 trillion printed and created during COVID. $4.6 trillion is a popular exact figure. Well, when Richard was first here with us in 2014, the national debt was $18 trillion, and now it's more than $33 trillion. So it's nearly doubled in just this past 9 years here.
That's right. But of course, which is the highest it's ever been, except for a few quarters ago. We also have to keep in mind that the economy is a whole lot bigger now than it was 9 years ago as well. So the ratio of government debt to GDP, while it's extremely high at somewhere around 125% government debt to GDP, that's still well below half of Japan's government debt to GDP. Japan's government debt to GDP was above where U.S. government debt to GDP is now, more than 20 years ago. So it's not like this high level of debt that the U.S. has suggests that we're about to topple into some sort of crisis with the government unable to pay its bills or incur more debt in the future. Japan has been on this road for decades before we got on this road, and they're still traveling down the road doing quite well relative to the alternative, which was collapsing into a 1930s-style Great Depression in 1990, 30-something years ago when their bubble first popped.
Sure, everyone wants to know how much debt is too much debt, and I don't know that there's a simple answer there. But yeah, it's interesting that you bring up that Japan is kind of that precursor to where we're going. Their debt to GDP ratio has long exceeded ours. And sure, Japan's got its problems, demographic and otherwise. They're very well documented. But yet, remarkably, this small group of islands that's globally remote is still the third largest economy in the world, Japan. That's completely a different subject. But Richard, now that you talk to us about what's happened in the economy and where you think we're going, investors are really probably most interested in, okay, now that you've talked a bit about the economy, what's this mean for my job? And what does this mean for asset prices, positive and negative factors on asset prices going forward?
Okay, well, let's go through the negatives first, because I believe that there are more negatives than positives. But having said that, there are quite a few positives as well. So let me move through this list fairly quickly on the negative side. I've already mentioned quantitative tightening is sucking $95 billion a month out of the financial markets.
Yeah.
High interest rates should deter borrowing and cause credit to slow further, and that will be a drag on the economy. In the near term, student loans have to now be paid again, and that's going to dent consumption. That's not going to be helpful at all to the economy in the short term.
Right.
We also have a strong dollar. The dollar is strengthening again, despite many people forecasting that the dollar would collapse. And I must admit, I was one of them initially 20 years ago. It hasn't. My views have changed entirely since then. In fact, the dollar index is now around 106. That's about 9% above its average since 1971. Just as a fun fact. So the dollar's strong. It's stronger relative to its average rate since the Bretton Woods system broke down. But when the dollar gets stronger, that tends to cause stock prices to fall. Whenever the dollar goes up, the stock market goes down. It seems pretty possible that the dollar is going to continue to strengthen because Europe's economy is going into recession, most likely sooner than the U.S. economy. They're likely to begin cutting interest rates sooner than the Fed begins cutting interest rates, and the same in the UK. And so the interest rate differential will become wider, and that will put more upward pressure on the dollar and likely cause the dollar to rise and stock prices to fall. So that's another worry. Then a very important worry for the stock market is asset prices are really very, very inflated compared to historically where they should be. Now, people used to say, okay, that's true, but interest rates are so low, we can justify the higher valuations. But interest rates aren't low anymore. And the thing I look at most closely here is a ratio I call the wealth to income ratio. And what this is household net worth, the wealth of all the Americans, divided by disposable personal income, wealth to income. Its long-term average since 1950 has been 550%. It's now 775%.
Okay, so said another way, on average, one's net worth is 7.75 times their annual income.
The reason this is a problem is because the previous two peaks in the NASDAQ bubble, this got up to 620, and then that was an all-time high. And then the NASDAQ bubble popped, stocks crashed, and it went back to the long-term average. Then during the property bubble, it went up to 670%. Property prices crashed, and it went back to the long-term average of 550%. Now we're so far above the previous peak, 775%, versus the previous peak of 670%, that this is telling us that stocks and other asset prices are inflated and very vulnerable to any unpleasant surprises, or the continuation of high interest rates, or the continuation of quantitative tightening. So I think that's a real worry for the outlook for asset prices. And of course, if asset prices correct significantly, then that would deter consumption, and that would be bad for the economy as well.
Right.
So that's the big one on the negative list. Then there's the possibility of a government shutdown, which is very bad news. If it occurs, helpful. Oil prices are high, approaching $100. That could put more upward pressure on inflation, and that could mean the Fed would have to keep interest rates higher for longer. So that's not at all helpful. So that's the list of negatives, and I think they outweigh the list of positives.
Let's talk about the positive side, the positive outlook for asset prices going forward.
So the main positive, again, is that this extraordinary amount of stimulus that the government pumped into the economy in 2020 and 2021 is still powering the economy. That money was sent out to households and to businesses, and they took those checks and deposited those checks in their bank. So bank deposits jumped by more than $4.5 trillion. That was something like a 37% jump in bank deposits in just a little bit more than 2 years. Nothing like that had ever occurred before.
Americans flush with cash.
It is. It's not quite certain who's holding that cash, probably not the same people who got the cash to begin with. I imagine that much of that cash has moved from the average and lower income households into the accounts of the wealthier individuals by now, but who have a lower propensity to spend. But nevertheless, there is a whole lot more cash than there used to be. Now, the bank deposits are coming down as a sort of direct and partially indirect response to quantitative tightening, but they're still down only $1 trillion from the peak, so they're still up nearly at least 3.5 to 4 trillion above where they were in 2020. So they're coming down, but there's still a lot of cash around. And that's the biggest positive going for the economy. Next, the unemployment rate is still extremely low at 3.7%, a low level rarely touched during my lifetime, although it's a little bit higher than it was a few months ago.
Right, where we kind of have the opposite of unemployment, where we still have more available jobs than available workers.
That's right. And then next, and I think quite importantly, since we spoke, in August last year, the CHIPS and Science Act was passed. And also in August last year, the Inflation Reduction Act was passed. Now, this is very important for the economy because with the CHIPS and Science Act, that is directing $50 billion to be invested in building semiconductor manufacturing facilities inside the United States. And such facilities are now being built in Arizona, Texas, and Ohio. They are under construction. This is creating construction jobs. This is going to allow the U.S. to build its own semiconductors going forward. And this, we can see now how extraordinarily important and well-timed this decision was, or maybe not well-timed. It should have occurred much earlier because AI is upon us now, and AI runs on NVIDIA's chips. NVIDIA's chips are made in Taiwan, and China is threatening to take over Taiwan. If China takes Taiwan, they get NVIDIA's chips, they control AI, and therefore they control the world.
Yeah, it's certainly timely to build our own chips here.
And then on top of that $50 billion going into chips, the remainder of the $280 billion is going into other industries and technologies of the future, R&D for other industries such as quantum computing, all of the others that I recommend investing in my book, the industries and technologies of the future, nanotech, robotics, neurosciences, renewable energies. And that then brings me to the Inflation Reduction Act, which is going to bring probably a far larger amount of investment, both U.S. domestic investment and foreign investment into the United States, going into new industries and technologies, at least $1 trillion worth of new investment, it looks like, as a result of that. So that's a very positive thing for our economy and also for our society and for our national security all at the same time. And that's supporting the economy, and that's going to continue to support the economy during the quarters and years ahead, in fact. So that's on the positive list. I'd just like to see much more of that, more investment in new industries and technologies. And then another positive is the AI revolution is here. ChatGPT, Bard, they are just mind-blowing. What DeepMind is doing in terms of unraveling the structure of proteins and understanding the molecular structures, this is going to bring about a revolution in the creation of new medicines, just to give one example. And so there's going to be probably a very large productivity expansion as a result of all of the generative AI that we're experiencing, plus a lot of investment to support the development of large language models. So recently I've started doing macro watch videos on the Magnificent Seven just to explain what they are. And I've done one on NVIDIA and Alphabet, and intend over time to do the next 5 as well. So that's been very interesting. I think that's very important for everybody to understand what's happening there, because that is going to change the world. So other positives. Eventually, the U.S., I believe, will slow down. The economy will probably go into recession. That's going to cause the inflation rate to fall even further. And eventually, the Fed will not only stop hiking rates, but they'll start cutting rates. And when they start cutting rates, that will be very good news for the stock market. I expect that to occur probably beginning sometime, at least by the middle of next year, and probably sooner. And once they start, they're probably going to cut interest rates quite a bit. So that will be very supportive for asset prices and for the economy to pull us out of the recession that's likely next year. Finally, the U.S. current account deficit is very large. You can think of this as the trade deficit. Now, this sounds like a bad thing, that the U.S. is buying a lot more from other countries than other countries are buying from the U.S. Last year, the current account deficit was nearly $1 trillion. It won't be quite that big this year. It's more likely to be something like $800 billion. But the reason this is a good thing is that when the U.S. has a big current account deficit, that sends dollars overseas. Last year, it sent $1 trillion US overseas. Those dollars are accumulated by foreigners. And once they accumulate them, they have to reinvest them in US dollar-denominated assets if they want to earn any interest on those dollars. And so the larger the U.S. trade deficit becomes, the larger the capital inflows into the United States become. And right now, they're very large. And those capital inflows are going into things like government bonds, pushing up their price and pushing down their yield. We've seen yields go up, but they would have gone up a lot more if foreign investors weren't buying so many government bonds as a result of all the dollars they're receiving through their trade surplus with the United States. So this is something that is supporting asset prices and is likely to continue to support asset prices in a positive way. So that's the list of positives, and they're significant. I still think the negatives are more significant. And that's why I'm worried about the outlook for the stock market, for instance, especially since the wealth-to-income ratio is so exceptionally high. And I'm also worried about the outlook for the economy because with credit growth slowing and quantitative tightening, all bad things for the outlook for the economy, in my opinion.
A lot of negatives and positives on a macroeconomic outlook for the economy and asset prices. Yes, history shows us that advances in new technology and things like AI typically create more jobs than they destroy. We just often can't foresee where those jobs are going to be created. After the break, Richard, I want to ask you more about inflation and interest rates, which you already touched on. And I also want to ask you about your thoughts on the future of the real estate market, since that's in our wheelhouse. And by the end of the show today, Richard has a special offer for GRE listeners. He'll offer you a 50% discount on his popular video newsletter, Macro Watch. Also, is there a prospect of higher interest rates for a decade? That's next. I'm Keith Weinhold. You're listening to Get Rich Education. GRE listeners can't stop talking about their service from Ridge Lending Group and MLS 42056. They've provided our tribe with more loans than anyone. They're truly a top lender for beginners and veterans. It's where I go to get my own loans for single-family rental property up to 4 plexes. So start your pre-qualification and you can chat with President Chaley Ridge personally. They'll even deliver your custom plan for growing your real estate portfolio. Start at ridgelendinggroup.com. You know, I'll just tell you, for the most passive part of my real estate investing, personally, I put my own dollars with Freedom Family Investments because their funds pay me a stream of regular cash flow, and returns are better than a bank savings account, up to 12%. Their minimums are as low as $25K. You don't even need to be accredited for some of them. It's all backed by real estate, and I kind of love how the tax benefit of doing this can offset capital gains and your W-2 job's income. And they've always given me exactly their stated return, paid on time. So it's steady income, no surprises while I'm sleeping or just doing the things I love. For a little insider tip, I've invested in their Power Fund. To get going on that, text family to 66866. Oh, and this isn't a solicitation. If you want to invest where I do, just go ahead and text family to 66866.
This is GRE investment coach Andrea Newbern. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
Welcome back to Get Rich Education. We're having a macroeconomic discussion with Richard Duncan today. You can learn more about him and his great video newsletter, Macro Watch, at richardduncaneconomics.com. Richard, we are real estate investors here, especially with purchasing residential real estate for the production of cash flow. A lot of 1 to 4 unit properties, single-family homes up to 4 plexes. Sometimes we talk about apartments and multifamily, a sector that's been somewhat overbuilt. And overall, we have a housing shortage in the United States, especially single-family homes. I'm still pretty positive going forward for 1 to 4 unit residential properties. In 2020, we have what I have characterized with our audience is the housing crash that already occurred. It was a supply crash that occurred in the spring of 2020 when the available housing supply failed to make its seasonal rebound, and the supply crash has helped hedge against any price attrition. We have about 60% fewer properties than what are typically available. And this is something that has a rather inelastic supply where 3D printed homes and shipping container homes don't seem to be the answer to get us out of it. We have demand that keeps coming from millennials, the largest generation in American history, this huge cohort that's in their prime household formation years. Really, to have a lot of pain in the residential market, history has shown us that it takes a lot of desperate sellers in order to make prices fall in a big way, like with what happened 15 15 years ago. And today's homeowners in the United States have strong credit, a strong equity position. They have these low fixed rate payments still, the overwhelming majority of them, 4% mortgage rates or less, and inflation cannot touch their low payment. So you have households and borrowers in really good shape. And if mortgage rates fall, some think that prices are going to rise even more. So those are kind of my thoughts on residential real estate. Do you have any thoughts?
I agree with you. I think investing in residential property, rental property, you can let out and earn rental income from every month is a very good and important part of a diversified investment portfolio. And I have to admit, the housing market has held up better than I expected. It was negative just a little bit year on year for a few months. I believe the most recent month, it was up 1% year on year. That is residential property prices. I would have really expected it to fall more than that. And the reason I think I was wrong, and I'm sure everyone knows this by now, but with so many people sitting on mortgages that are averaging, let's say, perhaps 3.5%, they just can't afford to sell their home currently and refinance with a mortgage that's, 7% or more. So there is no supply, or the supply is extremely limited because people just can't afford higher mortgages. And the lack of supply has supported home prices much more than I imagined would occur, because I didn't anticipate that lack of supply for that reason. And it seems that lack of supply is going to persist. So the housing market looks like it's going to hold up better than I anticipated. I'm not sure we're out of the woods yet, though, because if the economy does go into recession as I expect, then the unemployment rate will rise, perhaps quite significantly, in which case people will find it more difficult to pay their mortgages, and they may not have a choice but to sell. And the high rates, the higher for longer, it's going to be increasingly difficult for the younger people who would like to buy homes, just are going to find it quite difficult to do that, particularly since many of them now are going to have to start repaying their student loans. They'll have even less money to put down or to pay monthly on mortgages. So maybe I was too bearish on the outlook for home prices when we last spoke. In the short term, I'm not looking for any sort of significant home price appreciation. I would expect continued flat prices to down somewhat, but not a crash.
Yeah, I don't see how a crash would occur. And it's pretty interesting. If affordability does get worse, it's already pretty bad. If that gets worse because borrowers need to begin to remake their student loan payments, well, that constrains affordability even more. And that turns more would-be home buyers into renters, or it keeps them as renters. Like I talked about, we're in this for the production of cash flow, although we like home price appreciation. At the same time, when we can get it, surely
over the long run, I'm sure home prices will appreciate over the next decades. And meanwhile, you'll earn rental income. So as a long-term investment, yes, I think I'm a big advocate of buying rental properties to earn rental income and cash flow.
Now, you touched a bit on where you think the future direction of interest rates and inflation might be. Of course, those two things are positively correlated and generally move in lockstep, although there might be a lag time between their movement. Some seem to think we could have the prospect of higher interest rates for a decade or higher inflation for a decade, and we're not going to be able to get on top of this. And I know you've pointed out the fact that, in a sense, you think that inflation sort of turned out to be transitory after all, over 2 years instead of one. I know Jerome Powell came out and said he wasn't going to be using that word anymore. But interestingly, where do you think this puts us with the future direction of interest rates and inflation? Something that I'm not good at predicting, but where do you think we're going for the long term there, Richard?
So I think the Fed was shocked by how high the CPI inflation went, peaking at above 9% in June last year. But we have to consider there were very unusual circumstances. First, everyone was locked down because of COVID, and they received big stimulus checks from the government. So they couldn't go out and spend that in restaurants. So they all ended up ordering iPhones and iPads and jogging machines with their stimulus money. And those things are made in Asia. The Asia factories were shut down because of COVID, so there was an increase in demand and a decrease in supply, and that causes inflation. Then, just when that seemed to possibly be simmering down, Russia invades Ukraine, causing a very big spike in oil prices and food prices and metal prices, creating another big bout of inflationary pressures. So all of these things combined, lots of stimulus boosting demand, combined with supply constraints because of COVID lockdowns and the war in Ukraine, were a special set of circumstances. What we saw then was a partial reversal of globalization because of the supply chain bottlenecks and the war. Now, those have been largely alleviated. At least the supply chain bottlenecks have been overcome. And so the inflation has come back down very quickly from a peak of above 9. A few months ago, it was down to 3. So transitory is a word that's gone out of fashion. But in fact, inflation was transitory. It was just transitory over 2 years rather than 1. Now, the reason I don't think, of course, if the war spreads in Europe and we have World War III, then we'll have another big round of inflation, of course. If COVID comes back and everything's shut down again, we'll have another big round of inflation. But hopefully those things aren't going to happen. And we're going to return to a pre-COVID global environment where globalization is resumes being extremely deflationary. The reason that we had such low rates of inflation from 2000 until COVID was because of globalization. When the U.S. buys things from other countries with ultra-low wages, that pushes down wages in the U.S. and it pushes down the cost of manufactured goods in the U.S., and that's disinflationary, and that drives the inflation rate to low levels, and that means that when inflation goes down, interest rates will go down. So I think, again, before too much longer, especially since I expect a significantly slower economy next year with hot growing unemployment, that will reduce demand and prices will fall, and we'll have lower inflation rates next year and lower interest rates next year. And assuming that we don't have any more global shocks that are inflationary, then we should return to the pre-COVID norm, with globalization keeping inflation and interest rates at a very low level.
What I think about sometimes, Richard, ever since Nixon visited China about 50 years ago, I'll say the average inflation rate has been 3 to 4% since then. If we didn't outsource all of this manufacturing and labor to China, a process that has kept prices down, I wonder how much higher inflation would be if that weren't happening. Like, that's prevented inflation from being higher in my mind.
Well, absolutely. When the Bretton Woods system broke down in 1971, that changed everything. Focusing on trade, before that time, it wasn't possible for the U.S. to have a big trade deficit in total or with any country in particular, because the United States would have had to pay for its deficit with gold, and it only had a limited amount of gold. And it would run out of the gold very quickly if it had a big trade deficit with China like it does today. But once the U.S. went off the gold standard, the U.S. didn't have to pay with gold anymore. And so it could just finance all of these imports with dollars or treasury bonds denominated in dollars. And so the U.S. started then, it went from having no trade deficit, really before 1980 even. But by the mid-'80s, we had a 3.5% of GDP trade deficit. By 2006, the trade deficit was 6% of GDP. That was $800 billion in just 2006. As I mentioned last year, it was nearly $1 trillion. So that would not have been possible if we stayed on a gold standard. That's only possible because we're on a dollar standard. And that dollar standard has been extraordinarily disinflationary for the United States, which has brought down the inflation rates from very high levels. We could not have had the growth that we've had because we would have had very high rates of inflation if the government had large stimulus programs, as it has really on a consistent basis since 1971. And particularly after the crisis of 2008 and during COVID, with the Fed financing those massive stimulus programs with paper money creation. At the end of 2007, the Fed's total assets were less than $1 trillion. They peaked last year at $9 trillion. So the Fed increased its total assets, or the amount of money that is created, by 9 times in 15 years. That would not have been possible at all under the gold standard framework. We would have had extremely high rates of inflation. The reason we didn't was because of globalization. Globalization was possible because we didn't have to pay with gold anymore. So China, and that has transformed all the trade surplus countries like China. When I first saw China in 1986, it was a very, very poor developing economy. Developing may be an exaggeration. It didn't look very developing that year. But within just a very short time, because of its massive trade surpluses with the U.S., it's been completely transformed. And now the same thing is happening in Vietnam. I was in Vietnam in June. Vietnam, last year, their trade surplus with the United States was enormous, $120 billion, more than any of the other Asian dragons or tigers except for China itself, twice as much, in fact, as the next largest. Can you imagine what $120 billion going into an economy the size of Vietnam's can do to transform it economically?
Right.
I used to go there in Ho Chi Minh City and look across the river. There were just empty fields. Now you look across the river and it looks like Manhattan skyline. It's just mind-boggling to see how rapidly it's transformed. So this dollar standard and the $14 trillion of cumulative trade deficits the United States has had, $14 trillion of deficits, trade deficits since 1971, that has transformed the world. That has pulled hundreds of millions of people in the trade surplus countries out of poverty and made all of the Asian exporters enormously wealthier than they could have imagined becoming in 1971. So it has produced a lot of good things. This system that I call creditism, with the U.S. is driven by credit growth now. As long as credit growth expands, it's good for the U.S., it's good for the world. The problem is with creditism, if credit contracts, we go into a Great Depression and spiral into a 1930s style crisis. So it's important to focus on credit growth because credit growth drives economic growth in this new age of fiat money.
That's something Richard is very conscious of, and he will update you with that with his video newsletter, Macro Watch, which we'll learn more about in just a moment. But Richard, just quickly, are there any action items, the best way that an investor can position themselves with what you see coming here in future years? You talked about rent-producing real estate for one. What else can one do to be best positioned?
There's a very good reason why all of the investment textbooks for the last 100 years advocate a widely diversified portfolio. Over the long run, stocks tend to do very well. Home prices also appreciate. And in this new age of driven by credit creation and money creation by the Fed, asset prices across the board are likely to tend to continue to appreciate over the long run. So it makes sense to have a diversified portfolio, including stocks and bonds. Bonds right at the moment are really quite attractive, I think. You can get more than 5% interest on a risk-free U.S. government bond, a 2-year government bond. That's pretty darn attractive, I think.
Yields are higher than they've been in a while.
We haven't seen that for a long time. And as I said, I do think that investing in rental property is a very good long-term investment, particularly if the home is sitting on a piece of land. I'm not a big advocate of investing in condos because there's no limit as to how many condos can be built, but there is a limit as to how much land there is in the world. Rental properties on a piece of land are, I think, a very good long-term investment. I also own some gold. I'm not a big gold bug, but I always think it doesn't hurt to have gold on hand in case of a very worst-case scenario. You can always grab your gold and skip town if you need to. So, yeah, diversification pays.
Yeah, we tend to like scarcity around here. Gold is scarce. Of course, real estate attached to a piece of land is scarce. And sort of back to our earlier point with this low supply, real estate is a non-discretionary purchase. If there were a shortage in supply of honeydew melon, people could substitute cantaloupe for it. But, you need to live somewhere. Real estate is that non-discretionary expense while it's scarce and it can be leveraged and it produces income. That's why it's our favorite around here. But Richard, one favorite of a number of our listeners is your video newsletter, Macro Watch. I know a number of them have subscribed in the past and they continue to want to be repeat subscribers because of all the good value that they get from your great macroeconomic insights. So go ahead and tell our listeners about your video newsletter and this 50% discount that you have for them.
Great. Thanks, Keith. So yes, Macro Watch is a video newsletter. Every 2 weeks, I upload a new video. It is me making a PowerPoint presentation about something important happening in the global economy. A lot of this might be focused on liquidity and what the central banks are doing, since I think the liquidity determines the direction of asset prices. Also, I look at credit growth, not only in the United States, but all around the world, and liquidity drivers all around the world. I look at the major economies, what's happening. Of course, the U.S. matters most because it's biggest. China matters the second most because it's the second largest. But I also look at Europe and Japan and developments there on the monetary side, the fiscal side, and their economies in general. And then more broadly, at big developments like the AI revolution that's occurring now, as I mentioned earlier. So these videos tend to be about 20 to 30 minutes long. They have roughly 40 or 50 charts each, which the subscribers can download and look at their leisure. And anyone who subscribes will have immediate access. I've been doing this now for 10 years. So there are more than 100 hours of videos in the MacroWatch archives covering almost everything important that's happened in the global economy for the last decade.
And subscribers get access to all of the archives.
That's right. And so I believe your listeners would find this very affordable. They can find MacroWatch on my website, which is richardduncaneconomics.com. That's richardduncaneconomics.com. And if they hit the subscribe now button, they'll be prompted to put in a discount coupon code. If they use the coupon code GRE, they can subscribe at a 50% discount. And again, I believe that everyone will find this really very good value and very affordable.
It'd be a very good ROI there at Richard Duncan Economics. Hit subscribe, enter the discount code GRE for a 50% discount. Richard, thanks so much for offering that to our listeners. It's been invaluable having your perspective, as it always is.
Thanks, Keith. I think it's very important for people to understand that the economy doesn't work the way that it used to when gold was money. So MacroWatch strives to explain to people how the economy really works today in this very different global economic environment we're in, where the government is driving the economy through federal stimulus or monetary policy. People may not like that idea, but if they don't understand that the government is directing the economy, they're not going to be well placed to make good investment decisions. So MacroWatch tries to explain and does explain the forces that are driving the financial markets in the 21st century. So thank you very much, Keith, for having me back on. It's always a pleasure talking with you, and congratulations on all of your success since we first spoke back in 2014. You had an amazing list of guests. You've done a great job interviewing them.
Well, and you've been a contributor to that yourself as both the first guest and the most recent guest. Once again, Richard Duncan, it's been great having you on the show. All right, so some answers from Richard Duncan. Recession and rate cuts, at least by the middle of next year, probably sooner. He thinks they'll cut rates not a little, but substantially in order to pull us out of a recession at that time. But of course, between now and then, there are always wild cards that pop up. Wars are inflationary to oil prices and a lot of other things, and America's funding of wars in places like Ukraine and Israel, just the funding of it itself is inflationary on top of that. And when they print more dollars to pay for all that stuff, then all the dollars that you are currently holding on to get diluted yet again. And you should be upset about that and act on that, because that is an ongoing act of monetary vandalism. Yes, the definition of vandalism is action involving deliberate damage or destruction to public or private property. And that's why all this longer-term currency creation is monetary vandalism. The organized labor movement, from UPS workers to Hollywood writers, all that effects that you had this year, well, all of those groups have some pretty big wins. Well, that creates higher wages, and that's going to get passed along to the consumer. Well, that's even more inflation. I mean, for example, the United Auto Workers deal with Ford. That means that assembly line workers can make $40 an hour by the end of their contract. Plus, we still have stimulus from the pandemic 3 to 4 years ago, like Richard touched on. All right, but how do we square up all that inflationary pressure with this shorter-term quantitative tightening, which is currency destruction? Aren't they opposites? I mean, could quantitative tightening put an end to all that? How do you square that up with inflation, currency creation, with QT, which is currency destruction? Well, one short answer there is lag effects. But, really, Richard's video newsletter, MacroWatch, it helps you understand effects exactly like that. So thanks to Richard today. I mean, if his video newsletter helps you make just one big decision over the next year, it'll certainly pay for the cost of a subscription many times over. And as usual, I don't receive any compensation if you subscribe to his video newsletter. I'm just a longtime subscriber myself, and I have benefited from it. So from RichardDuncanEconomics.com, if you like what you see, you too can subscribe and use the discount code GRE for a 50% discount. As always, I am sincerely grateful to you for joining me today. You weren't here for me, you were here for you. For the 474th week in a row, I'm Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.